Welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And as always, we like to do these videos as deep dives into topics. And this week, we're going to be talking about market valuations, specifically market overvaluation. So before we dive into it, as always, these videos are for your information purposes only. Do not construe them as advice. Always seek the advice of a professional, or do your own due diligence before taking any actions in your portfolio. And we do try to keep the information as up to date as possible, but things are always changing, so do double check all facts. So with that, let's dive right into it. So market valuation or overvaluation, sometimes called a bubble. How do we see that? How do we identify it? And how can you see that in your day-to-day investing in portfolios? Well, usually there's some very key signs. We've seen it throughout history. I'm going to talk about today. That is June 12th, 2020, in the middle of the shutdown, or the end of the shutdown as things start to reopen here. But these factors you can see throughout time, whether we were talking about 2001, which was the internet bubble. We saw bubbles in cannabis more recently. But it doesn't always have to be general market overvaluation. It can be a sector overvaluation. So there's some key things to look for. If we look back to 2001, we saw names like Nortel probably being the most famous, and Pet.com probably being the biggest part of hype in overvaluated markets. And that's when names or certain positions see massive gains without any warranted growth or income to substantiate the extra valuation or extra value that is being given to the stock on the markets. We saw it, Nortel got up to $140 or just north of $140 per share. And then, of course, in the collapse, it ended up being worth almost nothing. We also see it throughout history when Air Canada filed for bankruptcy years and years ago. Their shares were down to, I believe, around 80 cents. We saw the market starting to rally those shares up. Pure speculation. People thought that was too cheap. They were buying up the shares all the way up to $2. There was really no reason for that. Air Canada had already declared bankruptcy protection, CCAA in Canada. The company put out a special press release telling people not to be buying the shares, that they're going to be very likely worthless after the restructuring. And in fact, what we saw is those shares being rolled back 10,000 to 1 of the new shares. And one of the new shares came out, I believe, around $35 a share. So obviously anyone who bought it at $2 or anywhere along the way, value was wiped out. And you'd think that wouldn't happen very often, but we see it all the time. We're currently seeing it in the market right now. This last Monday, we had an all-time high in the market in the middle of this COVID crisis. And of course, if we look at the previous highs in February prior to the economic shutdowns, nothing has improved in the economies to justify a higher valuation, even with all the government stimulus to try to keep things running or try to keep businesses afloat, all of which will help. They're all very positive things, but we're certainly not in an economic position to justify a new higher market. And that's the general overall market, talking about the S&P 500. If we break down into that market, and we did a video last Tuesday on our weekly updates. I encourage you to watch that as well, because I had a few graphs on this. But we saw 4 to 5 companies that had declared or were about to declare bankruptcy protection, and their stocks rallied over 70% in one day. One of them, Chesapeake Energy, rallied 180% on the news release that they were about to declare Chapter 11 protection in the United States. So when we see that much speculation, people are buying what we call bottom feeding. People are looking at the value and saying that's cheap, it's got to go up. Sometimes we see new issues or new stock being issued, and people thinking, that sector is going to take off. We saw that a few years ago with blockchain. A company called Long Island Iced Tea out of New York decided to change the name to Long Island Iced Tea Blockchain. They had nothing to do with blockchain. They simply announced that they were going to explore the opportunities of blockchain and whether they wanted to do it. And the stock surged, I believe it was around 40% in one day. Obviously, with that kind of hype around one sector or one name, you're starting to see this overexuberance in markets. So do not get caught up in that type of buying. Really do your research. Anyone who was buying those neat companies that had declared bankruptcy protection or Chapter 11, JCPenney was another one, Hertz Rental was another one. Obviously, people either were not doing their full research into what they were buying. They were just buying on the dip, or they were just caught up in the momentum of the stock moving up. There might have been some short sale coverings in there, but certainly not justify that kind of move. So be very careful. Always do your research. Look at a company's earnings. Look at their cash flows. Is there growth in cash flow? Is the outlook positive? Can you see the cash flow growth sustaining the current valuation of that company? If not, don't buy. Our philosophy of investing has always been risk first, which has always led our portfolios, or I should say always, but most of the time led our portfolios to go to more and more cash as markets get overvalued. And that's a simple default by the fact that we sell some of our positions, or we trim some of our positions as we see that overvalue happening, and we just can't find good values to buy. So that ends up going into high interest money markets while we wait to find a good valuation. And the same thing happened in our portfolios going into COVID. The markets were high. There was a lot of risk at buying at that valuation. And of course, the market came off due to COVID, but I'm sure there would have been something else to bring those valuations down in 2020. And then we go looking for those good deals in those markets. So always be prudent about your purchases. Don't get caught up in hype. Know the company that you're buying. Know why you're buying that company, and not just because there's speculation out there, or things. If something's going up and you don't understand why, maybe you should avoid it. Sometimes you might miss out on a good opportunity, but sometimes you'll save yourself a lot of pain, because at the end of the day, someone's getting left with that overpriced position, and when it comes down, they're the ones going to be left holding the bag. So do keep that into account when you're investing. If you have any questions about a particular position, a sector, the markets overall, always feel free to reach out to us. You can go online to mikeonmoney.com, where you can reach us, find all these videos, see our latest blogs, contact us, or book an appointment, and we're happy to look at your portfolios, your financial plans, and help you move forward. As always, if you want to leave a comment, let us know future topics that you'd like to see. We always appreciate that. You can subscribe to see our regular videos, and I look forward to seeing you again. And as always, thank you very much.